Hi, I'm Mijun from the University of American Perspectives. Let's begin the United States stock market news for December 19th. Welcome once again to Mijun, where we consistently uphold the fundamentals of United States stock investing. It's already Friday again. It feels like time is flying by in December. In just 6 days, it'll be Christmas. I wonder if you all have made a lot of good plans for Christmas. My family and I are planning a short family vacation next week, so to let you know in advance, we'll be visiting Indonesia from Tuesday the 23rd to the 28th. Please note in advance that Mijun Broadcasting will be on break for 4 days, the 23rd, 24th, 25th, and 26th. This time, I'm planning to visit the hotel where I used to work when I go to Indonesia. So, I'll be staying for 3 nights at the Novotel Lombok on Lombok Island next to Bali, and then 3 nights at the Bogo Hotel near Jakarta. The combo hotel there is where I worked last. So, after a really long time, I'm planning to meet up with my former colleagues and catch up. And the 2 hotels I'm visiting this time are very meaningful to me. The people who are currently working as general managers there are all my friends. Some of them are former colleagues and juniors I used to work with, and now they're general managers at those hotels. So, not only will I be visiting my Indonesian colleagues whom I used to work with, but I also plan to meet Korean general managers after a long time and have a great time together. I'm already feeling really excited about it. I'll work hard on the broadcast until Monday, and then I'll be taking a break from broadcasting for 4 days. For those who have joined the Mijun membership, you don't have to worry because every morning, no matter what, I'll do my best to provide at least 3 to 4 hours of membership content for Mijun members. Membership. All right, then let's get started with today's Big Tushin news prepared for December 19th. Yesterday, 2 videos were uploaded to the Mijun channel. One was the regular broadcast that I uploaded, and the other was a video uploaded in the morning by Chief Executive Officer Kim In-jung with the very interesting title, "If you don't look at semiconductors now, you'll miss the investment trend." Personally, I hope that Chief Executive Officer Kim In-jung's video gets a lot more views. Objectively speaking, it contains valuable information and content that can help you build your investment skills. So if you have time, I think it would be great if you could watch the videos uploaded by Chief Executive Officer Kim In-jung of ChoiceDAC at least once. Tomorrow is Saturday. As always, I recorded the United States Stock Elementary School video yesterday for this week. As usual, the content of this week's United States Stock Elementary School broadcast is also really good. I'm looking forward to this episode because I think the content will be fresh and original. Because one of the most important investment indicators when we invest in growth stocks is what's called an economic moat. An economic moat is, even if a company enters a very large market, when competition intensifies, prices inevitably drop due to competition, which leads to lower margins and slower growth rates, and as a result, the stock performance of growth stocks isn't very good. Companies with an economic moat can continuously maintain pricing power, keep or even improve their margins, and sustain their growth rate. So for people like us who invest in tech stocks and growth stocks, it's really important to look at the economic moat that companies have. But the problem is, it's hard for us to quantitatively determine whether a company has an economic moat or not. But in tomorrow's episode of the American Stock Elementary School video, Chief Executive Officer Kim In-jung will explain how to quantitatively analyze this valuable investment indicator, the economic moat. Please make sure not to miss tomorrow's episode of Elementary School. All right, then let's start today by reading a comment left by one of our valued subscribers. The comment we'll be looking at today is a valuable post uploaded a day ago by someone using the identification pinkmobium. It seems like Japan's interest rate hikes will continue not only this month but also into next year. You've posted a short question asking, won't yen carry trade become a problem? As you can see, 4 people have liked it. So there are quite a few people who are worried about the unwinding of the yen carry trade. But today's comment, I think, was a very timely question. Because today, December 19th, is the day when the Bank of Japan announces its interest rate policy. And right now, experts in the Japanese market are predicting that the interest rate might be raised again. And according to some breaking news reported just an hour ago, Japan's consumer price index has changed, and once again, the central bank's target is 2, but it was reported at 2.9, which is much higher than the target. Now, if this happens, for 44 consecutive months, high inflation rates exceeding 2 have continued to be reported. So you can see that they are having difficulty controlling inflation. Therefore, this year's announced interest rate policy also makes it very likely that Japan will raise interest rates again. Now, if that happens, one problem arises. Japanese interest rates will reach their highest level in 30 years. If that happens, there's a possibility that the yen carry trade will be unwound. You remember the yen carry trade, right? Let me explain what the yen carry trade is. The value of the yen has dropped a lot, and Japan's interest rates have been extremely low. So it refers to borrowing yen at low interest rates and then investing that money in the United States or other countries. Especially now, the United States market is very popular because United States interest rates are high and the United States market is performing well. But if Japan's interest rates keep rising, the problem is that there's no need to come all the way to the United States to invest. You can just buy Japanese government bonds. Therefore, the possibility of the yen carry trade being unwound could increase even more. So today, I'd like to respond to the concerns of the subscriber who left such an important question. It is widely expected that the Bank of Japan will raise interest rates this week. According to London Stock Exchange Group data, the market has already priced in an 82% chance that the Bank of Japan will raise interest rates by 0.25 points to 0.75 at the two-day policy meeting ending on Friday. So, with a probability of over 80%, you can expect interest rates to go up again today. Japan has had negative interest rates for quite a long time, but now the Bank of Japan has raised them up to 0.75. That's how you should see it. And this, they say, is the highest level in 30 years. 0.75 may seem low, but the problem is it's the highest level in 30 years. That's the issue. Ueda Kazuo, the governor, appeared, and in his speech this month, he's now the governor of the Bank of Japan, he made it clear in his early December speech that a rate hike is coming in December. And after today's decision, it's also possible that he might send additional signals of tightening during the press conference. Japanese policymakers are working to curb the inflation that gradually rose between August and October. According to a survey released by the Bank of Japan on Monday, Japanese companies expect wages to continue rising next year as well. If that happens, it could make further interest rate hikes more likely. So even today's 0.25 increase is already a burden, and with the possibility of additional hikes next year, concerns are continuing to grow. American investors should note this decision, because if Prime Minister Yui signals an additional rate hike, it's because the so-called yen carry trade, where investors borrow Japanese yen as a cheap and low-risk source of funds to invest in higher-yielding United States treasuries or other assets, could be unwound. Ed Yadeni from Yadeni Research appears. This expert points out something the Bank of Japan's board is making clear, and that is, the Bank of Japan will no longer financially support global risk asset investments. So far, one reason the United States stock market kept rising was the inflow of money from Japan. They're saying that it's highly likely this kind of thing won't happen anymore in the future. Japanese investors have invested hundreds of billions of dollars in United States Treasury bonds in recent years, but rising interest rates could prompt them to move their funds elsewhere. And this is the worst situation for the United States, especially when investors are already worried about ballooning deficits and high AI valuations. The United States stock market is already shaky as it is. Well, there are about two reasons being suggested. One is that the government's deficit is too high, so people are saying America's golden age is over. This is the worst case scenario. The other is that the valuations of AI beneficiary stocks, which have driven the United States stock market, have gone up, and that's causing concern. So, in this situation, if it even comes to the liquidation of any trade, you can see that we would be facing a very difficult situation. Larry McDonald appears on the Bear Trap report. This expert analyzes that the carry trade is already in a vulnerable state because the yield gap between the United States and Japan is narrowing. The yield gap between the 10-year United States Treasury and the 10-year Japanese government bond has narrowed to 2. Just a year ago, it was 3, so as it narrowed by 1 point in just a year, the attractiveness of United States assets has decreased significantly. That's how we can interpret it. Now, let me share my thoughts on this situation in a word from Ji-hoon Mi. An additional rate hike by the Bank of Japan is highly likely to become an important factor for yen carry trade and the global financial market. However, in my opinion, it's difficult to judge the impact based solely on the rate hike itself, because the key factor that actually determines whether the yen carry trade continues is something else. The interest rate level itself is important, of course, but what's more important is whether the interest rate difference remains attractive even when considering exchange rate fluctuations. The direction of the yen-dollar exchange rate is crucial, and it's important to keep this in mind. Now let me explain what this means. What is the yen carry trade? You borrow yen at Japan's low interest rates to invest in higher yielding overseas assets like United States Treasury bonds or stocks. Now, for this strategy to work, funding rates must remain low and the United States-Japan interest rate gap should be maintained. And one more thing, it's very important that the yen is weak or at least remains stable. The profit you get from the interest rate difference is annually, it's quite limited. The difference is just about 2 at most, right? Now the problem is that the exchange rate can move so much in a short period that it can offset those profits. When it comes to exchange rates, moving by 5 or 10 is very fast. So, if you look at the recent trend of the yen to dollar exchange rate, this structure clearly shows why yen carry trades have formed. Here's the yen to dollar exchange rate shown in a 1-year chart. And if you look here, even just last April, the value of $1 was around 140 yen. But as you can see, this value keeps going up. What that means is the value of $1 is increasing and the value of the yen is dropping. So if you look at the current value, $1 has risen to about 155 yen. The yen has been weak for a very long time. So even though the Bank of Japan has been continuously raising interest rates recently, the yen carry trade hasn't been unwound. Because the value of the yen keeps falling, it wouldn't make sense to invest in yen. Now, in this kind of environment, even if the Bank of Japan slightly raises the base interest rate, the effect of the weaker yen on the exchange rate outweighs the increase in funding costs. That's how you should see it. As a result, there was little reason to rush to unwind yen carry trades. That's how you can understand it. Now, there are talks that Japan's central bank is raising interest rates by about 0.25 points, right? So, is this 0.25 points? If you look at the exchange rate now, it's not just changing by 0.25 points, it's more like 5 or 10. The yen's value is dropping sharply. So it's been an environment where you shouldn't invest in the yen, and that's continued from last April until now. Is that a fair way to understand it? Of course, the narrowing yield gap between the United States 10-year Treasury and the Japanese 10-year government bond is a negative factor, and it's definitely something we need to pay attention to. But just based on this alone, the possibility of a sudden collapse of the carry trade is still not very high. There are reasons for that. It's true that the interest rate gap has narrowed, but historically, the current level is still far from the point where carry trades are immediately and massively unwound. So, historical statistics tell us that only when the interest rate gap narrows significantly more than it is now, that's when unwinding will occur. Even with a narrowing interest rate spread, investors' behavior is unlikely to change much if expected returns on United States assets remain stable. So what that means is this. It means that only if United States Treasury yields drop significantly, or if the returns or expected returns from the United States stock market fall sharply, will large-scale liquidation likely begin. Now, there is a point where the situation could change. If the yen stops weakening and starts to strengthen, it becomes very risky, especially if the yen starts to rise against the dollar. The appeal of the yen carry trade could disappear in an instant. The profits from the interest rate difference, which are only a few percent per year, can easily be offset by short-term fluctuations in the exchange rate. Now, in this case, investors are much more likely to quickly close their positions to avoid interest rate losses rather than expecting additional profits. And there's one more important thing. It's highly likely that this will lead not to a gradual reduction, but to a rapid liquidation. Now, of course, it's hard to say that a rate hike by the Bank of Japan will immediately lead to a stronger yen. So far, since April, the yen has continued to weaken. That's because there was a reason for it. Japan's current economic situation isn't that good, and also, Japan's base interest rate is still at a very low level. On top of that, the direction of United States interest rate policy is also uncertain. Furthermore, considering Japan's economy and trade structure, it's unlikely that the Bank of Japan would intentionally allow the yen to strengthen rapidly. As I mentioned earlier, Japan's economy isn't doing well, and Japan is a country that relies on exports. They need exports to survive, so would they really allow the yen to keep rising? It's highly unlikely that they would. Therefore, even if the Bank of Japan tries to normalize rates, they may only raise them slightly. Even so, it's highly likely that they'll try to maintain a balance so that the exchange rate doesn't fluctuate drastically. We can expect them to adjust things so that the yen doesn't become too strong. What's the outlook for the yen carry trade? It depends not just on Bank of Japan rate hikes, but also on whether the yen-dollar exchange rate will follow a lasting trend. Therefore, if the yen turns strong, that would be very risky, but if the yen continues to weaken against the dollar as it is now, it's likely that the trade can continue. That's what we can expect. If the yen stays weak, a major unwinding of yen carry trades is unlikely, but if the yen strengthens, the chance increases sharply. That's the summary. To evaluate the potential for unwinding yen carry trades in the future, the most important variable is not interest rates, but rather the exchange rate. So, as United States stock investors, we need to closely monitor which direction the dollar-yen exchange rate is moving. Here we can really feel once again that investing in stocks is not easy. This is the chart I showed you earlier, and we can also analyze this chart technically. Right now, the value of the yen against the dollar is here at 155 yen. If you look below, there's a horizontal support line, and this support line meets the 50-day moving average. That's at 154 yen. So if 154 yen is maintained, it's a very strong support line. Therefore, if it can just rebound from here, there's a very high possibility that the yen carry trade will remain relatively stable. If the 50-day moving average and the psychological support at 150 yen are both broken, it could become a problem. And if the 200-day moving average here, which is at 148, is broken, and if it falls further so that $1 drops to the 145 yen level, then at that point, the unwinding of yen carry trades could really pick up. And that's a situation we should be very concerned about. It's something we can anticipate. There's a new strategy and some hope here. If the use of stablecoins becomes widespread quickly around the world, then the demand for dollars could skyrocket. If the demand for dollars suddenly surges, the value of the dollar is likely to rise sharply. So, we can see here that the activation of stablecoins is also related to yen carry trades. Yumie, let's summarize yesterday's United States stock market. First, look at the S&P 500 map. We're seeing the picture we like the most. The overall market sentiment was just so-so, but our favorite AI beneficiaries and tech stocks showed a sharp upward trend. And the reason the market was so strong, especially for AI-related stocks, as you all know, was thanks to Micron. And yesterday, besides Micron's earnings, there was another piece of good news. It was the Consumer Price Index. Consumer Price Index stands for Consumer Price Index. As the Consumer Price Index came in lower than expected, fears about inflation eased according to reports. Let me show you the numbers for a moment. The headline figure, with the market expecting 3.1, actually came out at plus 2.7. So, there's quite a gap. A much lower consumer price index was announced compared to the market's expectations. Now, what's even more important is the core consumer price index. The market expected a plus 3, but it only went up to 2.6. Now, when inflation is under control like this, it's highly likely that the Fed will step in. If inflation drops and the economy slows down, the Fed is very likely to cut rates further to stimulate the economy. So you can see that yesterday's consumer price index results were good enough for the market to cheer. However, the market didn't go up as much as expected. The reason is that many investors don't trust the current consumer price index numbers. Right now, many market experts and economists feel this way. This consumer price index is not considered a reliable figure because the numbers that had been delayed were all released at once, and they haven't been properly recalculated. There are a lot of opinions like this coming out. We should consider it, but there are currently few signs of accelerating inflation. Therefore, personally, I would summarize this as a very big positive development. Also, the market breadth isn't bad either. For now, there are still many more stocks with a good short-term trend than those with a declining short-term trend, and stocks with a good long-term trend are still hovering around 60. Next is the market volatility index. The volatility index, if you look at it, it's not bad. Right now, it's dropped to 16.87, so the market is still enjoying a Goldilocks scenario. Low volatility can be interpreted as a very high possibility that the long-term bullish trend will continue. And it's the same when you look at the fear and greed index. Yesterday, all three major indexes closed in the positive, and the fear and greed index has now risen to 44. If it goes up just a little more, it will reach the neutral zone. We can see that the fear that was widespread in the market is gradually being alleviated. On the other hand, the crypto fear and greed index is a bit different. There is still some fear left, since it's at 21. If it drops just a little more, it would be considered extreme fear. So, it's still a bit difficult to easily pick up Bitcoin and Ethereum right now. Lastly, here's Mijuan's performance. Since leading tech and AI companies excelled, Mijuan also performed well. Of course, at the center of that is Micron technology. It closed after rising 10.21%. Secondly, Talon Energy gained 5.61%. Palantir rose 4.74%. Tesla was up 3.45%. Credo gained 3.31%. And Persola rose 3.05%. Personally, the stocks I recently bought generally showed outstanding gains, so it was a very good day for me. Taiwan Semiconductor Manufacturing Company gained 2.79%, Meta 2.3%, Alphabet 1.93%, Nvidia 1.87%, Advanced Micro Devices 1.49%, and Broadcom 1.18%. The rest are in the red. Especially stocks related to Bitcoin and Ethereum all fell. Bitcoin dropped to 85,370, and Ethereum is at 2,821. Sutika was the only AI stock to fall, dropping by 1.78%. Coinbase dropped by 2.04%, Bit by 2.82%, the Ethereum Exchange Traded Fund by 2.87%, and lastly, Bitmain fell by 3.04%, performing the worst. Now let's move on to today's main article. The title of today's main article is a bit grand, isn't it? I tried to make it interesting by calling it "The Second Nvidia Has Emerged." First, let's read an article, and then I'll share some personal thoughts I have about it. Let's read it together. Micron Technology's stock price soared on Thursday because Micron announced results that exceeded market expectations and provided guidance that was much higher than anticipated. And here's the important point. This is raising expectations that the AI trade can finally get on track. I completely agree with this part as well. So, is it possible to interpret this not just as good news for Micron, but as a major turning point that could shift the overall mood for currently underperforming AI beneficiary stocks? Micron reported an earnings per share of $4.78 for the November quarter, which exceeded the Wall Street consensus of $3.96 according to FactSet. Revenue also reached $13.6 billion, surpassing analysts' expectations of $12.9 billion. But the important thing wasn't just this. The guidance was outstanding. They set the current quarter's revenue guidance midpoint at $18.7 billion, while analysts expected just $14.3 billion? Joseph Moore, a Morgan Stanley analyst, shared his assessment. Moore gave high praise, saying that excluding Nvidia, this earnings result is likely the greatest revenue and net profit surprise in the history of the United States semiconductor industry. He mentioned Nvidia's earnings report from May 2023, which was the starting point of the AI trade. At that time, Nvidia announced tremendous earnings and raised its guidance, and thanks to this guidance, we saw the beginning of a surge in AI beneficiary stocks. To give you an idea, at that time, Nvidia presented quarterly revenue guidance of $11 billion, far exceeding the consensus estimate of $7.2 billion. It was incredible. The market expected $7.2 billion, but they said, we can do $11 billion. That's what happened. But if you look at the guidance Micron announced yesterday or the day before, it's the same story. Market experts were expecting $14.3 billion, but they said, not $14.3, we can make up to $18.7 billion. So, an incredible guidance was reported. Thanks to that, Micron's stock price surged 13% early in Thursday's session and later settled down a bit to close up 10%. Well, that's not all. Thanks to Micron, other AI semiconductor stocks like Nvidia, Advanced Micro Devices, and Broadcom also all rose together. Micron is a leader in the dynamic random access memory market used in PCs and servers, as well as the flash memory market used in smartphones and other devices. The difference between dynamic random access memory and the smartphone flash memory market is that dynamic random access memory it's a very temporary storage device. In PCs and servers, you have a central processing unit or a GPU, right? To run these, you need memory semiconductors, and that's what dynamic random access memory is. It's absolutely essential. And as for flash, when we usually take photos, we save those photos, right? This storage device is for long-term storage. This is what we call flash memory. That's how you can distinguish between them. Anyway, Micron is a company that does both. Especially high bandwidth memory or high bandwidth memory for AI servers is the most important core right now. That's how you should see it. This time, there was a very important reason for Micron's performance. Lately, sentiment around AI beneficiary stocks has been poor. In recent months, doubts have been growing among investors about the sustainability of building AI infrastructure. That's because there are concerns that the massive infrastructure investments by big tech companies and AI startups could lead to overcapacity. But what about semiconductor investors? Investors found reassurance in the positive remarks from Micron's management, who said that clients are signing long-term contracts for data centers despite previous failures. This is what Micron mentioned. Right now, our clients are eager to sign long-term contracts with us, and we can't even meet the demand. Because they said this, it was a very welcome comment from an investor's perspective. Sanjay Mehrotra, Micron's chief executive officer, appeared and spoke. He said that our business performance is expected to continue to strengthen through the 2026 fiscal year, so this is not the peak yet. It will get even better. What did the management say during the earnings call? They shared that the high bandwidth memory market is valued at $35 billion this year and will reach $100 billion by 2028. All high bandwidth memory supply is sold out through 2026. And they emphasize that memory chip supply will remain well below demand, so they still can't meet demand due to limited supply. The management also mentioned that large tech companies with strong financial power. They explained that demand is arising as these companies carry out their long-term data center infrastructure plans. Mega tech companies are still continuously buying memory semiconductors. And they delivered very good news that demand is increasing very broadly and significantly across all data center customers who want to sign long-term contracts. Micron's recent performance, guidance, and the management's statements are all evidence that AI infrastructure development is accelerating, aren't they? Therefore, so far there are no signs of weakness. That's how the article concludes. Now, I'd like to add my personal opinion on this and share it with you all. Recently, when major companies related to artificial intelligence announced their earnings, there have been repeated earnings surprises that far exceeded market expectations. You all remember this, right? Nvidia did that, as did Cred Technology, Broadcom, and now even Micron. These companies, it's not just that their results were slightly better than expected. They presented extremely high levels of performance and guidance that make us rethink the existing AI outlook itself. So if you just look at the numbers, it's hard to find any signs anywhere that AI infrastructure investment is slowing down. Now, despite that, the overall mood in the market is still cautious. Many investors are assuming that it's difficult for AI companies to continue infrastructure investment in the long term. They can't easily put aside their significant concerns that this trend might end up as a bubble in the near future. Now, this shows us that there's a huge gap between the reality shown by performance and data and the psychology of the market. There are reasonable reasons why the market is maintaining such a cautious attitude. Above all, the scale of AI-related capital expenditures being made by hyperscalers and megatech companies is bigger than any previous technology cycle. They're using an enormous amount of capex right now. And that's not all. As for where and how much stable profit AI technology will ultimately generate, companies still don't have a clear picture yet. They're making huge investments, but it's still uncertain whether these investments will actually turn into profits or returns. For investors who lived through the dot-com bubble or the metaverse and crypto crashes, those nightmares are resurfacing. That's how it appears. This time, the artificial intelligence cycle is fundamentally different from past speculative bubbles. First of all, the nature of the demand is different. Now, what does this mean? Artificial intelligence infrastructure is not a temporary trend or a consumer good. It's not something you use once and it's over, because data centers are more like production infrastructure that needs to operate 24 hours a day. Once they're built, it's not the end. The same goes for electricity, memory, network, and all computing resources. They all require continuous expansion and upgrades. Just having them isn't enough. Even after years of investing, you must keep investing each year. Demand is now driven by different factors. In the past, startups that relied on funding were at the center. The biggest reason the dot-com bubble burst was because it was a bubble created by startups. But what about now? When it comes to AI investment, big tech companies with massive cash flow, as well as the government and the defense sector, have become the main demand drivers. That's the biggest difference. Most importantly, there's a big difference. The fact that profits are already being realized is a big difference. During the dot-com bubble, stock prices often rose purely on expectations, without any real profits. Back then, there were many companies without any revenue at all. However, today's leading AI companies are actually generating record-breaking operating profits and cash flow, proving their value. The earnings results of Nvidia, Credo Technology, and Micron are not just based on vague expectations that AI will make money someday. They are proving the current ongoing demand with actual shipment volumes, contracts, sales, and guidance. Especially, as seen in Micron's recently announced high bandwidth memory case, the simultaneous appearance of contracts and supply shortages. It's very far from a typical overinvestment phase, so we can infer this. Now, nevertheless, the market still holds on to the suspicion that investment will eventually decrease. Now, what that means is the valuation of companies isn't soaring excessively compared to their earnings growth. In fact, it's being kept at a reasonable level and is continuously being moderated. Now, in this context, the area where the market is most open is AI infrastructure investment is seen as a cyclical capital expense. So it's only booming right now because the economy is good. In the end, many people think it will decline with the cycle. This was especially the case with Micron technology. Micron technology has always been cyclical. So there were a lot of opinions that this time it's hitting its peak and the day it will decline isn't far off. I've been continuously arguing against this. Right now, because AI is structurally growing, my personal judgment is that this cycle can at least be prolonged. And what about artificial intelligence? Gradually, it's not being considered a cost anymore. It's now seen as directly tied to productivity, national competitiveness, and military strength. I'm not sure if you've seen the robots that China is making, but the level of their robots is increasing tremendously. Now, with China making such advanced robots, if the United States just sits back, there will inevitably be a huge gap in military power in the future. Therefore, you can see this as a crucial central issue tied to national security. United States government actions also support the long-term sustainability of expanding AI infrastructure. Yesterday brought good news for Curran. The Strengthening Public Examinations and Enhancing Development Act passed the United States House. What is the Strengthening Public Examinations and Enhancing Development Act? It's about drastically simplifying the permitting process for building AI data centers and power grids. This has now passed the United States House and is awaiting passage in the Senate. This shows AI competitiveness is now seen as directly tied to national security. This means that an environment is being created where big tech companies can accelerate infrastructure investment without legal or institutional obstacles. Now, if the market has not yet fully accepted this kind of structural change, paradoxically, I see this as meaning that investment opportunities still remain. Now, while earnings continue to be revised upward, stock prices and valuations have not yet fully reflected that future. Historically, when have the greatest investment returns occurred? It's important to remember that the greatest returns were made just before everyone became convinced, when there were still many doubters, in periods where skepticism remained. In fact, for investors, the most dangerous moment it's when everyone is convinced and singing about a rosy future. So, even though revolutionary technological achievements are continuously being proven with numbers like now, the stage where the market still has doubts, in my personal opinion, this could be a period of great returns for proactive investors like us who respond ahead of time, climbing the wall of worry. Now, let me wrap up by showing you a chart. I mentioned that valuations are being maintained at a very reasonable level. The decisive evidence is the PEG ratio. Micro's forward PEG is 0.33, Advanced Micro Devices 1.19, Nvidia 0.98, Credo Technologies 0.70, Taiwan Semiconductor Manufacturing Company 1.22, and Celestica 1.20. What this means is that if you factor in the growth potential of these companies, not only are their valuations not high, but they're actually very cheap. In other words, you can say they're significantly undervalued. As I mentioned before, the most important and easiest way to find a 10-bagger is through PEG. If the PEG stays at 1.0 and growth continues to accelerate, that's when the stock price can keep rising steadily. So, in my opinion, not only has another Nvidia emerged, but I want to end by saying we still have chances to build wealth with artificial intelligence. The last content prepared for today is today's United States stock video. The expert appearing in today's video is... He talks about something similar to the argument I made earlier. The AI investment trade has started, of course, thanks to Micron. So the atmosphere wasn't very good because of Oracle, but Micron kicked off the AI trade. Can we understand it this way? Now, it would be good for you to listen and see what kind of logic is hidden here. If you listen, that's all for today's United States stock news on December 19th. I sincerely thank everyone who invested with Micron this week as well. Tomorrow, December 20th, I will see you again with Chief Executive Officer Kim In-jung at the United States Stock Elementary School. Let's all keep fighting together until the day we all retire through United States stock investing. Have a happy day. Thank you.
The guest is not worried at all about the current situation and evaluates today's strong rise in Micron's stock price as a sign that the AI investment theme is coming back to life. This is Michael Sansotera, Chief Investment Officer at Sylvent Capital Management. Some people are shaking their heads at this move, while others are sighing with great relief. What do you see happening right now?
I think this scene really shows how strong the actual demand is. There are a few chances for signals like this to appear this year. Looking at the demand trends shown by Micron and the quantities already secured through future contracts, it becomes clear that the AI investment story is still alive and much more solid than expected. In the short term, this was a period that could make traders or some investors feel a bit uneasy, and in fact, there was some tension in short-term trading even at Sylvent Capital. But in the end, what really matters is the fundamentals. The upper end of the earnings per share guidance range is already open at 75, and the overall timeline has been moved up by several years. Having an average annual growth rate of over 40% for the next few years is something almost unheard of in the memory industry. At this level, demand is literally exploding, and even if you look at it, it's not an exaggeration.
Let me sum it up in one sentence, just like asking ChatGPT this question. If you were to explain everything happening at Oracle, the changes confirmed at Micron, and what will happen in the future across all AI investments in one sentence, how would you say it?
Through Micron, we're seeing clear signs that semiconductor demand remains strong, and through Oracle, AI. Doesn't this again show that free cash flow, not debt, is the key to infrastructure investment? Looking to next year in AI investments, large cap companies with strong execution and rising capital expenditures stand out. Winners are those who fund 80 to 90% of their capex with self-generated cash, not debt. Is staying put the most reasonable and rational strategy for companies?
Yesterday's guest also had a pretty positive long-term outlook on Oracle, saying that Oracle is a company that holds exclusive enterprise data. He believed that as AI models evolved, their strength would eventually bring results. Ultimately, it's each investor's choice to make that bet now. But I agree with your summary. If free cash flow is key, what's the outlook for next year? Is Oracle an exception? Or should we be concerned that other mega-cap companies might also face similar issues?
Yes, overall, the mega-cap companies seem to be doing fine. Most of these companies cover 80 to 90% of their capital expenditures with operating cash flow. This is great, but ultimately, Oracle is the main point, right? We don't hold Oracle, but it's clear that the market is not comfortable with the amount of debt Oracle currently has and its dependence on it. So I see that two different stories are unfolding at the same time. One type is companies investing with free cash flow, earning valuation multiples that reflect this. The other type relies on borrowing for investments. Here, the market's evaluation will differ. It's not just Oracle. Small and mid-sized companies are also growing fast but need to take on debt. And it doesn't mean that this strategy has failed, nor does it mean that there is no demand. I interpret it as the current market already sees enough risk in AI itself, so it's not willing to price in additional financial risk.
Can I understand it as you're betting on companies that can cover these investment expenditures with enough cash and therefore have no particular reason to worry about AI investment trends being shaken in 2026?
That's right. Ultimately, it's the hyperscalers. It may sound cliche, but the main point stays the same. Companies like Google, Amazon, Microsoft, and Nvidia are in that group. We also hold a large stake in Nvidia. It's only natural that these companies will continue to see massive demand going forward because they can easily raise the capital needed for investment on their own, and their growth continues as a result. Ultimately, demand focuses on companies with both financial strength and execution ability.
Whatever the dream, the beginning is important. Be a little ambitious and grow little by little every day. Enjoy today's journey. Even if dark times come, I'm not afraid. Retire with United States stock.